Worldwide markets this week. Moody's downgrades US tells us what we already know. Sasol Capital Market Day, the market liked it. Renogen, a buyout offer. Results, we buy cars and famous brands. Today we've got local inflation, budget 3.0 and Oval Office at 7:45 p.m. This is Worldwide Markets, episode 631 for 11 May, recorded just ahead of market open. I am Simon Brown, and thanks to our sponsors. It's powered by Standard Bank Global Markets and Shift, the global money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest forex rates. Yeah, huge thanks to Shift and Standard Bank. But let's kick off with the news coming out of over the weekend, coming out of Moody's, the last of the three rating agencies to downgrade US debt. The first was August 2011. That was S&P, Standard & Poor's Global. And to be clear, they took them from AAA to AA+. We then had Fitch in 2023, also from AAA to AA+. And now Moody's from AAA to AA1. They have a different coding system. Moody's is usually a little later to the party than others. And in some points, it is semantics, right? The US is not going to default on their debt anytime soon, if ever, although there has been some talk around a Mar-a-Lago Accord, which could see maybe term durations and the like, a 10-year bond becomes a 20. That is extremely unlikely. But what it tells us is what we know. The US has a debt problem. And a debt problem is not the hardest thing to fix. In theory, you need to either increase revenue, which is raise taxes, or you need to decrease spending, which is cuts to the budget. The current budget proposal from Trump increases the deficit by 4.5 trillion. To put that in perspective, I think in Trump's first term, the budget deficit went up 7 trillion. In Biden's term, it went up 5 trillion. And now they're going to do 4.5 trillion in one go. The US has a almighty problem. Their interest cost is now more than their defense spending, which is the second biggest ticket item. Their interest payments have gone up around 3 or 4-fold in the last 4 or so years, and it's getting more expensive. The 10-year is floating around that 4.5%. This is all, short answer, bad news for the US. And again, I stress, it's not about defaults, etc. It's about what we know around that US debt burden, and that we also equally know it's not going away. And so how does it play out? Well, short answer is ultimately it squeezes the economy, right? Because your interest costs keep on going higher, your interest rate keeps on going higher, you're not cutting spending, you're not pushing taxes higher, and you spiral down into a squeezed economy which struggles to grow. Now, that is equally relative. When your global economy happens to be a quarter of the global economy, you don't need to necessarily grow so much. But it's that massive prosperity that we've seen in America over the last 100 years is being squeezed. We can also talk around de-globalization. That in of itself is incredibly real. And what that does in essence is it's going to make things cost a little bit more, which pushes up inflation a little bit and therefore keeps interest rates at a slightly higher rate. None of those big numbers, but you see it all kind of happening. We've also got the de-dollarization. No, not the end of the dollar. That might happen one day. It's not going to be in my lifetime, maybe yours if you're suitably young enough, but that is equally a long way away. So it is putting America in a very tight squeeze. And it really is saying to America, what the path you're on is unsustainable. But Congress is not going to do anything about it. I just saw a tweet come across, markets actually saying that in the next decade, they expect US debt to ultimately get down to only just above investment grade. And again, that's around a cost issue. Our debt in South Africa, we've been sub-investment grade since 2016-ish, maybe it was 2018. I forget when Moody's finally stuck it to us. But the impact is we have higher cost of debt. It's just that simple. And look, we're doing the same. And in fact, we have budget 3.0, 2 o'clock this afternoon. Expectation is that the cabinet has approved it, so it'll get through the GNU, nice and simple, that there is no VAT increase. But subsequent to the February budget 1.0, when the minister was expecting 1.9% GDP growth this year, that has been revised down to somewhere between 1 and 1.5. So revenue lower. Spending, well, how are we going to fix that? We're going to have to do some cuts. There's been theories that the fuel levy might get hiked. Maybe they slap a rand on there and solve it that way. We'll get more insight from that later today. We've also got local inflation out due at 10 o'clock. Market's looking for another sub 3% number. It was 2.7 for March. Market's saying maybe 2.8-ish for the April number. And then, of course, the MPC next week. Announcement will be Thursday. We need a 0.5% cut. At an absolute minimum, we need a 0.5% cut. And then this evening, 7:45, President Ramaphosa and Trump will meet in the Oval Office. It will be televised. I won't be watching it. I'll find out what happens in the morning. I suspect it is going to be, messy, I guess, is perhaps. So there is some points that Trump has that are perhaps valid. Most of them are not. He's probably going to repeat lies around genocide and the like. But I suspect Ramaphosa is a really good negotiator, but he's really good at it sort of behind the scenes. This is in front of cameras. It could get quite messy. We've seen other meetings in the Oval Office. If you're not sort of absolutely sucking up and praise singing, it starts to get quite messy. We'll get that 7:45 p.m. tonight. Let's quickly touch on the Rand, because the Rand is doing some crazy things. More than anything, the Rand's move is on the back of dollar weakness. We've seen the dollar index is now down at 100 again. So certainly we're seeing some pressure happening in dollar. The Rand, the 1830 level, which has in the past been an important level, has been absolutely taken through. We're currently trading at 1790 and looking like more strength. And ultimately, look, we've had 1, 2, 3, 4, 5. This is our 6th week of strengthening. And that after the week of the, what was it called? The Liberation Day tariffs, where our Rand got to almost 1990. We've literally picked up 2 rand on the currency against the dollar in the last little while. And I think 17 is possible. Of course, the one I've been watching really closely as well, because it's got less of that noise, is the Rand Euro. That is largely been sort of range bound between 19 or so and 21. It did also spike on Liberation Day, going up to 22.82. That is now back at 2029 and some change, but it's broadly been sideways since May of last year, and the 21 level remains a critical level for the Eurozone, and we have got below that, which in many senses is good news. And while we're here, let's have a quick look at gold, because gold is once again on the move. Jibulin Zabande is saying, yep, things are happening. It's on the move. It's trading at 33.17, but it remains in that consolidation that we're seeing at the moment around about the 3,300 level. I keep on saying, we could get back to a sub 3,000 or 2,900, and that would be great. That would be a great buying opportunity. But gold remains strong and is absolutely holding on and saying, you know what, we're going absolutely nowhere. So the other big news, in fact, 2 pieces of big news out of the market on Tuesday. The one was the Sasol Capital Markets Day. The chart on Sassol's actually been looking somewhat better, finally, although I note it's only back where it was on that Liberation Day on 2nd of April. But we have finally got some higher highs on the weekly chart. We are finally back at the resistance level of around 76, 77. We've managed to get through that. The stock is probably going to $100 at this point. The Capital Markets Day, a couple of things. They're going to only pay dividend when the debt levels are below sustainably below 3 billion rather than 4, which is a step down. But if you remember, where basically the relevant government department said you can measure your pollution in the way that you prefer rather than we would like you to do, and that means that they're spending a significant amount less on decarbonizing. They still say they're going to cut by 25% by 2030. They're pushing their renewable target up to about 2 gigawatts. They think they can run Secunda off a lot more renewable and less coal. obviously helps for pollution, and they reckon they can get Secunda back to its nameplate production, which it's currently not at. The Lake Charles, they're saying, yeah, look, it's a problem. It's not off the table to sell it or something, but that is not an immediate priority for them. And they spoke positively, and the stock was up over 10% at one point, closed around 8% higher. It remains challenges. I mean, they reckon that they're profitable at oil above 50. It's 50 is a long way away. We're in the mid 60s at this point. It remains an immensely cheap stock. Forward PE is some 2.5. So that is not an issue, but it's still not going to be easy for them, I suppose. And they made a lot of promises, but they need to resolve those promises. Interestingly, just as recent as December 2022, so call that 2.5 years ago, price targets were sitting at 600 Rand on the top end. The top end is now 180. The average is 116, and the low price is 70. Sassol is 79.50 at the close. 3 holds, 4 buys, and 2 strong buys. If you like Sassol, this might be your moment. This might be your point to quickly jump in. Folks are like, oh, it was 55 just the other day, and you've 40% plus up, and you've missed it. Yeah, you're always going to miss that initial move. I mean, that is not a surprise for anyone. Bottom calling, which folks have been trying on Sassol for absolutely forever, has just been painful. You've been buying at all sorts of levels, some around 250, some around 150, some around 100. It hasn't been fun. You wait for the bottom to more be confirmed. And I got to say, that weekly chart is looking good. It was looking good on last week's close. It's looking even better on this week's close. The other big move was Renogen, which I can't spell. Renergen, there we go. An announcement that they have got a buyout offer from ASP Isotopes. I will chat about that in a moment. That took Renogen at one point was some 60% up, and that only takes it back to August levels, August last year levels. So there's still some ways to go. They had results. The results were a bit of a horror show, and they hadn't yet started really producing helium for the period. So there's a lot we still don't know about that. The deal is going to be, in essence, an equity deal. ASP Isotopes will buy out Renogen. You will get about 0.9 shares per Renogen share. That puts the price at around about the 12.50 level, which is where it got to yesterday. It closed at 9.72. 38% higher. ASP Isotopes will then list in South Africa, and thereafter we will find they will have one of their assets will be Renogen. I have to say, I mean, I have a lot of thoughts here, and one of them is I'm just wondering if this isn't Steph Marano, the CEO, in some senses, kind of throwing in the towel, maybe. And I know that maybe seems a bit extreme, but now he's going to be a CEO of a division within another company. ASP Isotopes, I spoke to Paul Mann a couple of weeks ago at my MoneyWeb Now show. They do pet pharmaceutical, they do isotope business, which is both including, they do agri. Obviously, there's some nuclear power in there as well. They do medical. There's a fair bunch in the healthcare space. They've got a quantum leap energy, which they are going to spin out in the second half of 2025. And ultimately, they then also own Renogen. The idea is that isotopes are in huge need, as is helium, as is LNG, and this then puts them all together, and they all have between them, well, collectively, as a listed business, they will have lots in that space. And that's not wrong, although there was a report on Currency News. I tweeted it, which some short sellers saying not so sure about it. ASP Isotopes was down 6.9% on the news. It had a much worse response at one point. ASP Isotopes EV sales 117. Next year is expected to be 12.2. They're going to have to issue a lot more shares. They have been issuing shares since Jan of 23. They've gone from a little over 30 million to a little over 72 million new shares as well. And there's one buy target, and the target is 850. ASP's currently at 7. Renogen Look, the helium and the LNG is at Virginia and the Free State. That is not a problem. Getting that out of the ground and to market is undoubtedly a challenge. It is expensive. A lot goes wrong. Renogen and the team absolutely have discovered that. They need to get the LNG to market. They need to get helium in phase one, and then they can turn to phase two. I suspect that they were finding that turn to phase two. They needed to list on the NASDAQ. They didn't want to issue shares at the massively deflated share price. Does this solve the problem? Kind of, maybe. As I say, it does look about a sort of a capitulation, as I say. I mean, and I don't necessarily mean that in a bad way. Steph Morano's done a great job over the last decade. It is tough, and I think they're paying the price perhaps for that toughness. We will see. We'll get more details. This is all supposed to happen, if memory serves me. The details, the expectations and the like are expected sort of around late Q3, Q4 of this year. Let's get to some results. We had We Buy Cars. There's, of course, a lot of moving parts here because a lot of new shares were issued, but it does put them on a PE of around 20, a forward PE of 17 and change. You can see the massive issue of shares around the listing. Of course, there's costs around that listing at the same time. I liked the business, and I liked the results. There's only one buy price target of 50. Current price is 44.33. They sold in November. They got over 16,000 vehicle sales. That came off a little bit over the next couple of months. I think that November was probably significantly helped by the two-pot system. But if I do some quick math, so they sold 16,000. Their 3-year target is to get to 28,000. We're doing about 40,000 new vehicle sales. New second-hand vehicle sales are about 2.2 of new vehicles. So let's call that 90,000 new vehicle sales a month, which means that at current levels, they're running at about 18% market share, and they're looking to get that closer to around 25, 26% market share. There's a fairly simple way that they do it, and I've spoken this before. Look, I've said before, my wife bought a car from We Buy Cars. It was in the Western Cape. She liked it. She sent View for You to go and inspect it, because you know what? We go inspecting a car. What are we looking at? Oh, that's a nice color. Oh, look, it's got wheels. I don't know nothing. Anyway, viewforyou.co.za, they cost a little over $2,000. They came back. The report was excellent. Everything looked lovely. The We Buy Cars guys then shipped the car up to Johannesburg for us at no charge. It all went smooth. Now, I know a lot of folks on Twitters are telling us around the disasters. The thing with We Buy Cars, they will buy any car. So they've got cars on there that are not lemons. They are just duds. They are like spare parts more than anything else. And I think a lot of folks just aren't quite understanding. But when you're selling, 15, 16,000 cars a month, and you plan to get that to 28,000 cars a month, which is more than 50% up from your current levels, there are going to be some things that frankly go wrong. That might even be We Buy Cars' fault, and maybe they handle it badly. But they're essentially looking to boost that revenue by over 50% over the next couple of years. And I like that business model. And we are going to be buying a lot more second-hand cars than we are going to be buying new cars. The other set of results I want to quickly touch on was Famous Brands. They actually weren't bad numbers. There's a tough consumer out there, and that surprises absolutely nobody. So that was not to be unexpected. But a price earnings of little under 11 is not too bad. Dividend yield of a little over 5 is equally not too bad. Price action in of itself, it's kind of gone nowhere in the last 3 years, a little bit up. I still think that perhaps the better here is Spur. Spur has the better balance sheet in many senses. Stock's been doing well. They've got potential there. But of course, they are a consumer play. And at this point in time, we're better off at this point than we were a year ago as South African consumers. But let's be very, very clear. It is still exceedingly tough out there. Everyone in South Africa knows that. And the casual sit-down dining is struggling as people just eat out less frequently. That, again, is of absolutely no surprise to anyone. As I say, it's tough. And your consumer faces are going to experience that most of all. Worldwide markets powered by Standard Bank Global Markets and Shift. The Global Money app, your go-to for travel, shopping, payments, and investments in the palm of your hand, all at the cheapest Forex rates. As always, thanks to Shift, thanks to Standard Bank. We really appreciate the support. My name is Simon. We'll be back again next week. As always, look after yourself, and if you can, look after somebody else as well. Cheers all.